Good morning, everybody. Welcome to the Blacksmith Podcast, where we forge guys into men. I'm your host, Will B. Live and in the flesh. Sorry, I am running late today. A lot of stuff going on. But let me just get the opening out, right? Over here, we forge guys into men by helping them become the men that they envision themselves to be in 15 years. We do that by ensuring that they have a vision, right? A long-term vision. Can they see themselves in 15 years, right? What does that guy look like? Is he well educated, well read? Is he a buff dude and you're skinny? Do you not read books and he's well read? Is his vocabulary more expansive? Does he have a house, wife, kids? All that kind of stuff, right? And looking at that guy up and down is going to create in you motivation to want to be that guy, right? So you got to look at what he's got and see, and that's going to motivate you to want to be him. Then number three, we've got to take action. We got to get creative. I'm sorry. Number three, create actionable steps. So you reverse engineer how he got that degree to your life right now. And that's how you're going to get there. So if he's got a degree in engineering, then you need to start looking at colleges today. And if you need to go to a JUCO or a community college, get your GPA up and then go to engineering school, you do that. That's how in 15 years, you'll have a bachelor's degree. It won't take you that long. And then 4, action. You got to take action. 5, persevere. You got to persevere through rain, sleet, snow, come what may, high heat, all of that kind of stuff. So that's what we do over here. And Saturdays is a special treat because it's the only day I actually go live. For now. And we discuss financial topics. So you'll see on my screen, you should be able to see it. It's just Google. But actually what we're going to jump right into is I'm going to rehash a subject I talked about before by popular demand, dividends. But before we do that, a little bit about what's been going on, right? So I've had a full 2 weeks. I've had some family court appearances. I promoted the senior chief not last week, Wednesday, the week prior. Oh, the 14th. So that was a blessing. My mama's in town, so that's a blessing. My brother's downstairs with her and my little nephew. So that's a blessing. Then somebody smashed into my wife in my Model 3, my commuter. She's okay. The car might not be, but so I got a rental right now. It's the, whatever you call that electric, Mustang, whatever it is. It's got the picture of the horse. I understand it's not a Mustang for all you Mustang heads out there. Whatever you eat, Mach E. That's what I'm renting right now. It's quick. It's whatever. But so I've had and that just happened yesterday. So I've had a full 2 weeks, a lot more stuff going on, but I am here for you. And so let's get into it. Now, I think we should probably start. I think I should probably stop and get my words together, but I'm a real person. This is no AI. Ain't no deep fake here. This is me in the flesh with the T shirt. You know what I'm talking about? I got bars. No, I don't. I'm just kidding. All right. So I think it's important to start with a basic understanding of how economics and how money works, right? So you work a 9 to 5, you earn money. You get taxed on that money. So what you gross before taxes is not what you net after taxes and what gets deposited into your bank account, right? Now, I made a short this week and it was kind of controversial, I guess. Not really, but it kind of got people thinking. Anybody out here, chat, feel free to throw something in here and I'll go over it on the show. Y'all know how we do. If you're just new and you're joining us, then maybe you don't. But if you throw something in the chat, I will read it live and I will handle it, right? So people are very enthused and they're on this subject of 100 men versus one gorilla. Where did this come from? Why is this? How is this? Who, what, where, how, when, why? What the heck? Why are we talking about this, right? So I made a short and I said, who cares? And I stand by that. Who cares? 100 men versus a silverback. Who cares? So I made a short saying, well, what if we took 100 men's paycheck versus one inflation? Who would win? And that kind of gets your brain turning, right? Let me see if y'all can see this. Y'all can see my calculator can you see this? Yes, you can. All right, let's talk about it. So the average man, we just gonna do it like this, folks. We gotta do it. The average man, it says, earns $17.94 an hour. Now, the average work week is 40 hours. It's like 32 to like 40 hours. We just going to take 40 hours because historically that's been the average work week, right? And then we're going to multiply that by 52 weeks in a year. Now, in the video, I said 56. It's 52. All right. I said plus. What am I doing? All right. I'm going to get my mind right. Hold on. Now times 40 hours a week, let's hit enter, times 52 weeks a year. So that's the average man's paycheck right there, $37,000. Let me make sure y'all can see it, $37,315.20. Now, that's gross. That's before taxes. So after taxes, you're probably only knocking down like 30 G's, 32 at max maybe, right? All right, so now let's multiply this times 100 men. Right? Because we want to do time versus a gorilla. I'll show you what the gorilla is. The gorilla is called inflation. All right. So 100 men's paycheck, that's a lot of buying power, $3.73 million. Right? Well, now, what is inflation? Inflation is 3% a year. So let's multiply this on up times 0.03, right? That is how much this gorilla inflation is knocking down your paycheck, 100 guys, right? A year, right? And this is if you had, now let's say this $3.73 million was sitting in a savings account, because that's what mom and daddy taught us, right? Invest. They taught us work a job 20 to 40 years, retire, get the pension, and then when you're old enough, you get Social Security and save your money, and all will be great. Mom and daddy only knew what they knew. All will not be great. There is a gorilla or a barbarian at the gate, and it's called inflation. So let's talk about this gorilla. This is what we're going to silverback today. All right, so this is beating down your paychecks, right? So now that is in 1 year. Let's say you had $3.73 million in a savings account, and you may say, who cares, right? But a savings account deflates 3% a year because the amount of what they give you for a savings account is negligible. It's like 0.25%, if that. So basically nothing, right? So if you had $3.7 million in a bank account January 1st of 2024, January 1st of 2025, it would still be $3.73 million. However, the buying power of it would have dropped. Let me see. It's 3.73. So I'm not going to do the whole number. We're just going to get to it. All right. So minus 3.73. I think it was 1,000 equals. All right. So you would still have $3.73 million in the bank, but it would spend like 3.6 million. Maybe it doesn't sound like such a big deal, but it is a big deal, right? Because if you were to take 111 point, I can remember this, 31945. We're going to clear this out. Uh-oh, speaker turned off. 945 times 10 years. That's what, if you didn't put any more money in that savings account or checking account, right? In 10 years, that's how much your $3.7 million would have deflated. Houston, we now have a problem, right? Because now you've lost millions, right? However, let me see, was it 3731? Let's zero out from there. Now your $3.7 million is only spending like 2.6. Houston, we have a problem, right? And most of y'all don't understand this. So that's why I'm here doing this for free. I have a heart to teach people financial literacy because I had to learn. So if you don't want that to happen to your money, then you must invest. Now, investing is putting money into something that is going to it's going to net you a return, right? In fact, I like definitions here. So I'm going to show you what the definition is, right? And then I'm going to tell you the Blacksmith Podcast definition. So investing in a financial context, meaning using money to purchase assets because assets inflate, liabilities deflate. So cars, that's why I'm not gassed to have a Mach-E. Who cares? It doesn't use gas either. So assets with the expectation that they will either appreciate in value or generate income. All right, so now that's the definition of investing. Now let me tell you what the Blacksmith definition of investing is. Putting your money into something that is going to outpace inflation, right? Because you could put your money into a high yield savings that's doing 2.7% in interest. Inflation's still beating you by 0.3%, right? But if you put it into a high yield savings that's getting 4%, 5%, or a savings certificate, savings CD that's getting 4%, 5%, now you're outpacing inflation. If you're not outpacing inflation, your dollar is deflating. So Houston, again, you have a problem, right? So now let's talk about one of the greatest ways to outpace inflation, and you can earn some equity on your money as well. I asked this question like a month or two ago on the podcast, and I think it was 100,000. Well, we'll start there. Put it in chat. What would you do with $100,000 if somebody came to you and said, "Here's $100,000. Do with it what you will." Put it in chat. I'm gonna give y'all a little bit, and then I'm gonna talk about the first thing I want to tell y'all about is REITs, right? We're going to rehash this subject today because it's backed by popular demand. But if you look at my tabs up here, I have more lined up for you. I have the Costco's earning call. We want to talk about Costco as a company, terrific company to own shares of. We're going to talk about, I guess I didn't pull anything up on this one. And then we're going to talk about the president with the iPhone tariffs and how this is going to affect Apple stock if you want to buy it, right? So the first thing we'll talk about is going to be REITs, right? What is a REIT? A real estate investment trust. If you never heard about this, look, I'm going to tell you something. Now, I don't have a whole lot of notes written for this show today, but this is my notebook. This is my notebook. I keep investing. Look, Blacksmith, I keep a notebook and I keep investing knowledge in this as I get it. I give it to y'all. X gonna give it to you and I'll be X. All right, so REITs, real estate investment trusts. They're companies that own, operate, or finance income producing real estate. They allow investors to participate in real estate ownership without directly owning the property. REITs can provide investors with regular income, diversification, or potential for long-term capital appreciation. What does all of that mean? I'll break that down in the Blacksmith definition. Basically, REITs are a way to invest in the real estate without you having to have $100,000, $200,000, $300,000, $400,000 to buy a property. I think when I looked it up, the average home in America is now like 416 grand, and it had a slider to like 520, right? That's a big average gap, right? That's like a 90K average gap. Let me see. Let me see if it's still, I don't know why it always opens to this tariffs page. Let me see. Average home price in US. All right, so here it is. It's 416 to 503. So we'll just take the 416. It's a way for you to invest in the real estate without you having to actually buy a home, right? just take it as is, right? So now there's pros and cons to REITs. I think it's mostly pros, honestly. But when investing, you're going to look at a stock and you're going to say, is this an equity stock or is this a dividend stock, right? And so REITs are not equity stocks. They don't increase in the amount, in the evaluation. Those companies don't go up in the equity a lot per year, right? They may only increase 2% in equity. So what am I talking about? If it's $10 per share, it might only increase to 12 by the end of the year, or it may stay the same, right? But an equity stock like NVIDIA might be $113 today and shoot up to $300 by the end of the year. That's an equity stock, right? There's a point to dividends though. But anyway, let me not steal its thunder because it probably has a flow here. Okay, so these are the kind of companies that they own, right? So income producing, office buildings, apartments, shopping malls, hotels, warehouses, right? They can be bought on public exchanges. So Robinhood is my champion over here, right? And they generate income through rent, mortgage interest, and other real estate related activities. And now here's the biggest part of all. I don't want y'all to miss this. If you're new to this, if you heard this before, that's fine. But if you're new to this, I want you to catch this. So REITs, they actually avoid paying taxes a lot of times because they distribute at least 90% of their taxable income out to the shareholders as dividends. So they are going to pay the highest percentage of dividends you're ever going to get in the stock market, right? And let's just compare, right? This is my champion right here, ORC. So ORC is my champion dividend stock. Let's see. Where is it? It right now is paying a dividend yield of 20%, right? Now let me show you something, because the average equity stock doesn't even pay a dividend, doesn't even pay one, because you get your return from the equity. So you bought it at $100 3 years ago. Now it's $200. There's your return. You got 100 shares. You got $100 per share. Do the math. 10 grand, I believe it is, right? 100 times 100. I don't know. I think I'm wrong. I might be right. Hold on. There you go. 10 grand. I thought so. All right. So now, let's do average stock dividend. Y'all may think I'm passionate. I play no games over here when it comes to investing, right? So the average dividend from the S&P 500 is 1.3%, right? What did I just show you? ORC pays a dividend of 20%, right? That means in 1 year, out of a $6.95 investment, it's going to return to you 20% of that, 20.81. So if you want to do easy math, 10% would be 69 cents. So if you just double that, it'd be about 70 cents because it's 9.5. So let's just go with 70 cents. If you double that, that's $1.40. It's going to pay you every year for owning this per one share, right? But it's going to give it to you in 12 increments because REITs also pay monthly. So let's run down all the pros so I don't keep getting ahead of myself. So they pay huge dividends. Let's see. Does it have pros and cons? I should have did a sheet on this already. Okay, I can run them down. I ain't got time for this. So they pay huge dividends. They pay monthly dividends. And also, they stack, right? If you have on drip, you can have your dividends reinvest. And what am I talking about? So I'll show you an example. So right here, you can see I have $9,700 worth of Orchid Island capital. Let's get to the money because we want to get to the numbers. Now, it has decreased 9%, almost 10% since I bought it. So I've lost $1,000 on the equity in the stock. But understand, I don't buy stock for a year. I buy this stock for 5, 10, 15 year, the long run. So this will recover, not even worried about it. So I have 1,396 shares, right? Now, I bought them at an average price of $770 and it's at $695. That is why I'm down this much, right? All right. So this is why I buy it. You see this right here? It is paying me $165. This is monthly, per month, right? It may not sound like a big deal to you, but this later on can be turned into passive income. And how many people out there who are not military and retired, who are not civil, what do you call them? Civil servants? Something like that. They're in civil service, like they're a police officer, a firefighter that still pays pensions, and you got to retire in order to get it, right? Most jobs don't pay pensions anymore. So most people's passive income, if they have it, is coming from a pension, if they have it. And if you didn't know, if you joined the military on or after January 1st, 2018, they no longer pay pensions. So you have to wait until you're 60 years old in order to get your retirement, right? So don't sneeze at $165 a month. Actually, I started with $3 a month worth of a dividend. So now 165 times 12, that's $1,980 a year, right? And that's just from one REIT. I have more, right? So this one, what's going to happen though? Let's go back. So when it pays me this 165, what is it? 31, because I can see it behind it. When it pays me this amount of money this month coming, let's say Orchid Island Capital is still at $6.95. I have DRIP turned on. So it's the dividend reinvestment program. So it's going to reinvest this $165 into this stock, which means you divide this by $6.95. It's going to buy me 23.785 more shares. Why is that important? Because those 23 shares also pay 12 cents per share. So that's an extra $2.85 that it's going to pay me the next month. So instead of getting 165.31, I'm going to now, a month from now, receive 168.16. Why is this important? It seems very small, minute, and it builds incrementally. But in 10 years, this stock, so right now, this stock right now is buying me almost 3 shares a month, right? And so if you multiply that by 12, let's go 3 times 12, that's 36 shares it's buying by itself per month. I also have a weekly buy of $15, and there's 52 weeks in a year. So let's say we do 15 times 52. This is next level game. I hope y'all appreciate, because a lot of people don't tell you this, right? A lot of people, you'll see articles, oh, they were able to retire at 40 or 38. They earn $4,000 or $16,000 a month in dividends. How do you think they're doing it, right? They started at 18 because grandpa or their dad worked in finance or somebody knew. And since that time, a huge percentage of their paycheck was going into dividends, right? So $15 times 52 weeks is only $780, right? But now let's multiply. Let's divide that by $6.95. So I am actively buying every year 112 shares, right? But the dividends in themselves compiling on each other is buying about 36, because it's about 3 a month, right? Now you take this, multiply this by 12 cents. So that's going to be in 12 months, an extra $17 of dividends every single month. That's what it's going to work up to. But in 12 months, it'll be an extra 1778 worth of dividends every month. Now add that to 165.31. There's going to be your dividend yield in 12 months, right? Which that's per month. So times 12 would then be $2,100. Now, if you do this 10, 15, 20, 30, 40 years, just imagine, right? My goal is to get this up to like $5,000 a month. My mortgage is 4, right? So if I fell on hard times and I ever needed to pay my mortgage, guess what? I don't have to go to my brother and be like, yo, man, I bought too many Snickers bars this month, man. I had to get some Jordans or the light bill was due. I don't have to do that because REITs will essentially, from dividends, allow you to become your own lending institution, so to speak, right? Because how does this work? Let's say you are earning $5,000 a month. You needed to pay your mortgage. Let's say I needed to pay my mortgage. I can stop it investing when it pays me the $5,000, turn off drip, right? And you can turn it off at any time, right? It'll still pay you the dividend. It'll just go right here. It'll go right here to your buying power instead of going into the stock itself, right? So now let's say you stop the dividend from reinvesting, you take $4,000 out, transfer it to your bank account, which then transfers and pays your mortgage. Now you will have to pay some tax on that money at the end of the year when you file taxes. Don't worry about that. You need your mortgage paid, right? You can't split hairs, right? So now you take that extra 1,000 and you manually invest it back into Orchid Island Capital, right? You invest it, buy as many shares as possible. That way, you are never draining the pool. You're still investing $1,000 of the dividends is paying you, and you only took 4. So you're still you're still allowing it to build. And let's say you needed to do that for 6 months, right? So now you've taken $24,000 out of the dividends, but you've invested 6 still. So it's still creeping up. Your dividend's still increasing, but you paid your mortgage and you kept your lights on while you were in between jobs. Now, when you go to pay taxes, yeah, you'll have some money that you'll have to pay out of that, but you just helped yourself survive by having vision today for 15 years in the future. Hopefully that makes sense to y'all. I hope y'all like the dividend conversation because we're going to keep having it. Chat's got something for me. I'm appreciated. The taxes are cheaper. You are exactly right. The taxes are cheaper. And thank you. Thank you for your support. Thank you. Thank you. Again, this is next level advice and next level, investment information that I never got taught. I had to learn this, right? I got the same thing y'all got. Work a great job for 20 to 40 years, save your money. I found saving CDs on my own. But my parents couldn't teach me what they didn't know. They were loving parents. They created a great household for us. All 6 of my siblings. That's right. I said 6. I'm one of 7, not 7, SEMM. All right. So I'm one of 7. And I'm going to tell you right now, I had to learn this stuff. So I hope y'all appreciate. I'm glad that you do appreciate it because I think if you're not reinventing the wheel, you're going to move a lot faster than somebody else. Right. All right. Or than if you had of. All right, so that's Orchid Island Capital. The ticker is ORC. And again, we can run down this. We can look at it. It hasn't done well in the last year, but again, historically, it has done well, right? But that's the 5-year marker. It's down 65%. In the past year, it's down 18. Year to date, it's down 11. It's down 21 in the past 3 months. So you may be asking yourself, why would I buy it if it's all red? Because when it's red, it's dead. I'm just kidding. So that's how people see it, right? When it's red, it's dead. That's not how you should look at stock, right? Think long term, first of all. Nothing is quick money, easy money. If it was quick money comes with quick problems. And if it was quick money, you'd probably be on the street corner somewhere with a number and a TH after it, 56th or 32nd or something. And quick money come with quick problems. So those penitentiary chances. There are no penitentiary chances with the stock market if you're doing it the right way. Now, if you're insider trading, that's penitentiary chances, but that's white collar crime. So you'll probably be in a celebrity jail. All right. So, okay, quick story. I follow this guy named Wall Street Trapper, right? He's a good guy to follow on the tube of you. This guy is from Louisiana. He makes no bones about his background, right? And he went to prison for attempted murder. Let's go. Who cares about Megan's fight? This is what I'm talking about. Like this guy right here. So this guy right here, Wall Street Trapper. This guy is from New Orleans. He went to prison for attempted murder. He makes no bones about it. He tells you a story. But the thing I found fascinating about his story is that it was not about a life of crime. He tells you that's where he came from. He does not speak the best. His speech is like, you get what I'm saying? Like it's from the hood, right? So he said that he was locked up with an inmate that was in there he did turn himself around. I saw that, chat. I caught it when it popped up. That's what I'm talking about. Yes, he turned himself around. There you go. I'm going to get at 100 too, because you are right. He turned himself around. He actually did. So there's two parts to jail, right? You're supposed to serve the time to your community and yada, yada for what you did. You did the crime. Now you're supposed to do the time. But the other part of jail is supposed to be rehabilitation. This guy actually did that. And kudos to whomever this guy is that he talks about, because he's the reason that he helped turn it around, and he makes no bones about that either. All right, look, his cellmate was, he said he was a white guy, right? And that guy, back then you had to go pull somebody's file to see what they were in for. Now I guess they can do it by electronic means. So the guy told him that he was in for 18 months. And he said he was in, I forget what his stint was, but the guy was in for 18 months. And he said, well, what did you do? He said, I embezzled $10 million. And he said, man, get out of here. And he said, no, I'm serious. I embezzled $10 million. And or $3 million. And what he did was he paid 1.2 of it back and kept 1.8. And he was like, man, get out of here. That's a tall tale. Like, what did you really do? And he told him, no, that's what I did. So they pull his file. He found out, wow, you really did do that. He kept $1.8 million and got 18 months. So they basically gave him a month for every $100,000 that he kept, right? White collar crime. It's different than blue collar crime. It's not my penal system. I didn't do it. But what happened, he said the guy used to read the newspaper every single day. Right. And he's like, dude, what are you always reading in that newspaper? And he said, oh, I'm reading the stock section. Right. Those of us who can maybe with a little gray in our beard might remember newspapers. Right. I think it's legendary. I think it still exists somewhere out there. So he was always reading the stock section. Long story short, he learned how to read stock, how to tear down a stock, how to itemize all the numbers underneath the stock, and how to trade stock from this guy. He learned how to do options. He learned how to invest in equity stocks. He learned how to know what a good company was, if they have cash flow or if they're in debt. He learned all that stuff from this guy, and he became hungry for this kind of information. And I bring this guy up because this is the guy I learned about REITs from. This is the guy, right? Earn Your Leisure, EYL, is, I jumped in the stock market game 5 years ago. Best thing, one of the best moves I ever made. One of, right? Earn Your Leisure. These guys right here. So this guy, right? Okay, the guy on the left with the glasses is Troy Millings. The guy on the right with the glasses. Okay, let me get off of the video. Y'all can see this, right? Yeah, you can. The guy on the right with the glasses is Rashad Bilal. These two are 66% of Earn Your Leisure when it started. The other guy is a Dominican cat named Mike they're all three from New York. Mike is the guy in the background recording everything. You never see him, but he did interviews, I think, last year with Dave Shands, another good one. Dave Shands, what's his podcast called? It'll come to me in a second. But anyway, these two guys started Earn Your Leisure with another guy, Mike, right? This podcast, I've learned so much. It's really a show, and it was an umbrella because it has other shows that come on it. These guys, I've learned so much about it. On the right is Rashad. He was a financial advisor. On the left was a phys ed teacher in a school, Troy Millings, right? These guys started this show in their bedroom, in the kitchen. That was sus. No, in their kitchen. They were on one half of the screen, and then they were in there together using a mic, and they just evolved from that. I'm not on that. I'm in my studio, which is the Forge over here, right? And so they gave this information away for free, and now every August they do Invest Fest, and they bring out tons of people. You gotta buy tickets. It's on their website, so they getting free promotion, but they have helped me earn money over the years, so this is me giving back. Anyway, I learned how to do the REITs from them. I found Wall Street Trapper, learned it from him. Now y'all are learning it from me. Pass it on. It's good information. All right. So now I ask y'all what y'all do at $100,000. Yes, it is. I only see Ian and Rashad. Oh, you only saw Ian and Rashad? Hold on. No. The video above it. Not the blackout one. You can't see this one on top? The top video. It's showing me that it's showing you on your screen. The top video. It says they don't want us to have the info. I can read. Hooked on Phonics. Math Hoffa, Ray Daniels, and O.B. Omele exposed or whatever. It's this video right here. The one that's playing. All right. So, moving on. Let's get back to it. So that is REITs in a nutshell. So my champion REIT over here on the Blacksmith Podcast is Orchid Island Capital, ticker ORC. And the reason being is because, again, it returns 20% dividend yield. Now, the dividend yield went up. It used to be 16, but the stock price went down, so they increased the dividend so they can keep returning you that same 12 cents per share per month, right? And you can do the math on how much you'll earn per month. And it's straight up. I'm not kidding. Y'all want to see where's the history at? I'm not kidding. I found this stock not that long ago. I think February last year, something like that. Yeah, February last year, right? I bought 100 shares. The stock was $8.47, right? So I bought 100 shares. I didn't care whether that was the stock being high, whether that was normal levels. So the money I lost in the equity probably was because I bought the share at a high. I bought the stock at a high. So I just wanted the dividends. So I just wanted to jump in wherever. So you see 100 shares at $8.47. Now it pays 12 cents per share. So 100 shares times 12 cents, 0.12 equals $12. Easy math, right? That $12 at $8.79, because it had gone up, bought me another 1.3 shares, right? And it shows you it's reinvested right here. Now, let me see. When's the next time I bought some? It keeps giving me $12.51. That's every month right here. I shouldn't speed past this. So in March, there it is. There's April, there it is. There's May, 12.16 now, because it's buying more shares that are paying more money. Here is June's 12.33. You can see it's building, right? Because I didn't really take it that seriously when I started. And so then right here in September of the same year, last year, I bought another 27, 222, because it was 8.16. And now let's see, 1287 is what the dividend got bumped up to. And then right here, October, bought 200. October, 3 days later, bought another 200. And you can see the share price is coming down, right? So, which is good because it's helping me dollar cost average down. And then I got a $16 dividend right here, which bought 2.1 shares. Now keep going, keep going. By November, it had caught up with this 200 and 200. So every month it has a day where it says, all right, you have 100, we're going to pay you this dividend. If you bought later on that day another 100 shares, you're going to have to wait until the next month. So the smart thing is, and I did this with ARR, and I'll show you the history. I bought another 100 shares, and then right like at the day before it did that and paid me the dividend based off those shares. And then I sold it like 2 weeks later, but it paid me the dividend based off of what I had that day. And I sold it. So I got a higher dividend, it reinvested. And you could do that if you wanted to. You could bounce back and forth, but just don't get burned on the equity side of it, right? And then the transaction fee is only like 25 cents. So you won't get burned there. All right, so look, now it's catching up. So now we're at $65. Now it's buying 8 shares. I could keep going, but I think y'all understand. And you can see 67, 68. Now we're at 70. I didn't have buying power here, so it failed to buy. And then I started it again. So now look, I bought $5,700 in April. So this is last month. Why? Because I sold Earn. Earn stopped being able to trade on Robinhood. And that's the one I trade on. That's the main one I trade on. So I sold all the Earn, bought 768 shares. So now, boom, 165 a month, right? So you can do it too. It's very, very simple. ORC. Now let's quickly deal with ARR. We're going to speed through ARR because I got some other topics I want to get to, but REITs, I could talk about REITs all day because I'm telling you, it's great for your portfolio. Oh, when you watch it, you only see those two. Yes. I was only really showing that for the purpose of showing you who the guys were. But if you go to Earn Your Leisure and you look at videos, they have playlists, all that kind of stuff. They have episodes where they're interviewing. If you go through the playlist where they're interviewing, you can actually see the CEO of this, Robinhood, Vlad Tenev. Vlad Tenev, they've interviewed him 2 times. Where's Hood? There's Hood. This is my MVP stock for y'all that didn't know. Robinhood. There it is. Vladimir Tenev. They've interviewed him twice. I think I can't remember the months or whatever or the year when it was. But if you scroll through just EYL Vlad Tenev or Vladimir Tenev, it'll come up. So this is my MVP stock over here. This is not a dividend yielding stock yet. In fact, they asked them, if you watch the Discord live where they talked about, where I did the earnings call, they asked if they were going to pay a dividend. Now, see, if you see, no dividend yield right here. If you look, no dividend yield. But this is an equity stock. This stock right here, year to date, is up 62%. In 1 year, 225%, right? So that is at least 3x. So if you bought it a year ago, you 3x your money, at least, right? And you can see, I don't just talk it, I walk it. I sold 100 of these like 2 weeks ago when it went back up because I borrow on margin. I consider myself a veteran investor. So if you have 30 grand in the stock market, Robinhood will give you another 30 grand to use to invest so you can earn more money. So what I did was I used it all, 100% of it. So I had a margin call when the stock market went down and I owed them money for like 2 months, right? Then when the stock market started creeping up, I said, okay, I'm gonna wait until it goes back to its levels. It went back to its levels. I sold some of my NVIDIA, my Robinhood, and Palantir. Right? It brought a tear to my eye, but that wasn't all my money. right? So I gave them some of their money back. I'm still borrowing some on margin. So it's not all my money. I'm using their money to earn more money, but that's what happens when you have money, people are willing, when you do for yourself, people are willing to do for you, right? So when you build good credit, people will loan you more money. When you have more money, you can borrow against your own money. Anyway, enough with that. So Robinhood. All right. I was going to deal with ARR. So ARR is the only other REIT I have right now. There are other REITs out there. In fact, let's do ARR, and I'm going to show you how to find some more. All right, so ARR, my dog is scratching at this door. All right, so I have 413 of these at an average cost of 19.44. So I'm down $14, $1,400. Now this one, I know I had bought it at an inflated price, so I'm cool with that. But again, the dividends is off the chain. Let me show you why. Now, remember, it costs more than ORC. I'm earning 99 from this one with just 400 shares. Why? Because it pays 18%, but you have to do 18% off the cost of the stock, right? So if you just but do a quick Google search, and I'll show you how you can find it. Usually NASDAQ will come up. This one pays 24 cents per share per month. So see, it pays a quarterly dividend of 72 cents. If you didn't want to have to do the math and all of that, just look it up, dividend yield, and it comes up. Well, NASDAQ is down here, but this comes up. It's 72 cents quarterly. Remember, most REITs pay monthly, right? So you have to click into the NASDAQ and it'll tell you that. However, if you just divide this by 3, that's 24 cents. So this is only for one share. 18% a year for one share. So 72 cents every 3 months, that's 24 cents per month. That's what it pays, right? So this is how you find out. Now, you can go on here on Robinhood and you can do REITs. Search, sucker, go. Enter. See, I hate using this on the desktop. If you use it on your phone, you can just hit go and it'll go. Since I don't know how to enter is not working, I guess it just brings it up and you can look through all of these REITs right here. But there's many, many, many more REITs that Robinhood will show. I just don't know why it's not searching. All right, so I'll show you this. You can just Google it. High yielding REITs. Oh, I saw one down there that I'm going to go back to. All right, let me see if it's showing you. All right, it's saying Roots pays 13.67%. Vanguard only does 4.8. Blackstone only does 2. Okay, so it's telling you to invest in Roots. So that's just Roots by itself. But this is the one I saw. Phoenix Energy. It says that's interest rates. I'm looking for REITs, sucker. Don't give me interest rates. The best REITs to buy. Morningstar is a good one. So if you want to get into investing, start learning the different articles that you can use. So Morningstar is a good one. The Motley Fool is great. Investopedia is magnificent. They actually, Earn Your Leisure actually interviewed the CEO of Investopedia as well. Okay, so where we at? All right, so look, they got a list of them right here. Pebblebrook Hotel Trust, Park Hotels and Resorts. Let me see if I know any of these. I don't know any of these. And do they break it down by the dividend? Forward dividend yield, slap yourself. Okay, this one's 8.9. That's extremely high. If the average one pays 1%, these are extremely high, right? 6.8, 5.2, 7.7. Y'all get it. Just follow the blacksmith. I got you 2 high yielding dividend stocks. So there you go. Okay. Now, I think that's REITs in a nutshell. Chat, if you have any questions, let me know. If not, let me move to these next couple subjects really quickly because I think we're at 49 minutes, so I got a little time. So now, first, let's look at Apple stock, right? Because the article I'm going to read is going to affect that. All right, so Apple is trading at 195 right now. Year to date, I think they're down. Yeah, year to date, they're down 21%. Now, this is Apple. This is part of the Magnificent Seven, right? So you're looking at the REIT. If you're looking at the REIT and you're like, I don't know, why would I invest in it? I never finished my statement, right? If you look at a stock and all you see is red, look at the company's financials. Are they in the red or in debt, or are they cash flowing? Do they have cash reserves? What's the trajectory of the company? What are they looking to invest in? Who's investing in them? Look at the company real quick. And if it's a solid company like Apple, you can still invest in it when you see red. Because when you see red, what in the stock market, what you should do is liken that to walking through Target, Walmart, any other department store, Costco, and seeing 15% off. So right now, year to date, 21% down, 21.34%. Imagine Apple having a red tag with black lettering, 195.82, and then below it, it says 21% off. Would you buy that, or would you rather buy it with 40% markup? If it said 220 and it said 40% markup, I bet you that aisle would be jam-packed with whatever that product is, because nobody's going to buy it, right? So that's how you have to look at stock buying. You have to look at it as red is on sale, green is marked up. Most people do the reverse. They stay away from it when it's red and they buy it when it's green. So they're buying at the high. So a week later, when it comes down 10%, when it's just correcting to its natural levels, normal levels, because news came out that make it boom in the news. If it's in the news and you saw it on CNN, MSNBC, Fox News, whatever else, ABC, whatever else, if you see it on the news and it's booming, it's already too late to get in at the low. Once the news has it, too late. That's why you need to watch me. And no, I'm just playing. But Earn Your Leisure, they do a Money Market Mondays every week. So that's going to be a playlist that they have. And I'm suggesting them because I'm telling y'all these dudes have been doing it longer than me. And I don't have the hubris to say I'm better than them. No, I'm not. I'm nowhere near them. These guys are outstanding. It might be on their lives. Hold on. Lives. Here we go. So Money Market Mondays, if you want to see them every week, you're going to see Money Market Mondays and you'll see a blackout. Blackouts are entertaining. As you can see, I've seen a couple of them. That's their opinion on the stuff that's happening in the news. But the Money Market Mondays, you can see I've watched those. I've seen all of this one too. But anyway, so watch them. Figure out what's going on, because they get deep into the financials of a company and they'll tell you the trajectory of the company. I do that too on Saturdays, but I don't always do that. I teach about all kinds of stuff related to being financially literate. I think it's time to rehash some options as well. But let's read this news. So President Trump, he's the president, right? Again, before we go into this, remember, I'm not red, I'm not blue, I'm purple because I love green. All right, so why President Trump's iPhone tariff threat might not be enough to bring production to the U.S. So one of the things that he talked about before when instituting these tariffs, he said that one of his goals was to bring industry, the industrial age of America, when we were economically at our strongest, our peak, back to America. So what he's trying to do is force tariffs on these companies so they'll stop producing their product overseas, and it then becomes more lucrative to hire employees in America, pay them a living wage, and let us start producing our own stuff. Now, there's a lot of nuance to it, and there's a lot of barriers to entry for that because, as I told you before, sorry, I got to put all this stuff in the beginning if you're not economically sound or savvy, but the employee is the most expensive part of a business, right? So you have the wage that you're going to pay them, hourly or salary. There's a 15.3% payroll tax on every salary that you pay. You're going to pay for benefit packages for them too. Then there's unemployment if they get fired or let go, not for cause, right? There's what is it? Then if they get hurt, it's workers' compensation. All five of those, the job pays for them, right? That's the business paying that. And there was another one I ran across this week, and I was like, dang, I never even thought about that when I'm talking on the podcast. If it comes to me, I'll tell you. But all of this is the reason why the businesses started producing their stuff overseas, because instead of having to pay somebody $16 an hour, you can pay them $4 an hour. Instead of having to pay payroll tax on their salaries, you don't have to. And even if you had to, it'd be a fraction of what you're paying your guys over here. And then when it comes to benefit packages, you don't have to offer it to them, right? When it comes to the other two, workers' comp or if they got injured. Or no, unemployment. You don't have to pay that, right? So it's way more lucrative to do it overseas. And so that's what they're doing. And so what he's doing is trying to put big taxes on imports so they will start producing their stuff here. All right. Now, Apple CEO is Tim Cook. Let's just read these if you haven't read them already. So President Trump wants Apple to make iPhones in the U.S. Never happened. In my opinion, it ain't going to happen. And if they do, it's going to be a small satellite segment of their company. It's not going to be 80%, a large majority of their iPhones produced in America. I don't think so. Not going to happen. Anyway, so he threatened to slap a 25% tariff on them made outside of the country. Got it. Tim Cook, obviously, he doesn't have a little problem. He has a huge problem with that. Manufacturing iPhones in India, analysts say it would make more sense for Apple to eat the cost rather than to move production stateside. Bam, right there. And those are analysts. I'm not even an analyst for it. I'm analyzing it, but I'm not an analyst for it. Eat the cost. 25% is not enough to make them move. Now, if it was like 50, 75, 100%, now you might have to consider that. But given everything I just told you, the 5 things, there's a 6th one, and it's a big one too. I wonder if it has something to do with unions. But either way, the employee is the most expensive part of your company. So you don't want to bring it back here if all they're going to do is slap 25%. All you're doing is just taking their profit margin down, and they're an American company. So whatever. All right, so he used to have a solid relationship with Tim Cook is what they're saying, and yada, yada. They're just rehashing what they said up top. Now, they did do their earnings call, and he did talk about the majority of the iPhones sold in the U.S. from India instead of China, which, if you didn't know, for like political reasons, it's better to do business with India than China. There's a cyber war going on and all that kind of stuff. The U.S. don't really like China, but we produce and they don't like us, and we produce a lot of our products over there. What can I lift up this week and show that it was made in China? My headphones? Oh, it's too worn out. My wallet was probably made in China. I don't know. I have a Samsung, so I know, boo, thumbs down, whatever. I'm using it. All right, so that's pretty much what I wanted to talk about, right? So now let's look at Apple. So we looked at the year to date. 1 year, though, it's only positive 3.71%. But this news, now this is from Friday, I believe. It dropped 3%. So that's big, right? News like that can drop a stock if you're buying it for equity reasons. You hate that. But you want to see where the news is going, and you also want to see it as an opportunity. Now, if you know Apple's going to recover from this. So really, it's on sale. It's 3% off. Most of our stuff is made in China. Amen to that. You got it. You got it. Another 100 for you. You know, you're getting so many gold stars. I'm just playing. I'm just kidding. All right. So moving on to the next news. We talked about REITs and all of that. I think the last thing I want to glance over is Costco's earnings call. Now, Costco. Now, if you want to talk about a company that is a great company to own, it is expensive right now. It's just hear me out. Just hear me out. I know the price makes somebody's cortisol skip a beat, take a breath, breathe, stretch, shake, let it go, like May said, right? Now, Costco is a great company to own, and I'm going to go over some reasons why. Let's look at what it's done the past week. So it's down almost 1%. Past month, it's up almost 4%. Past 3 months, it's down 2%. Past year, it's up 10%. And 1 year, 25% increase. That's phenomenal. Let's look at the 5-year chart. Ooh, 233. Costco's cooking. They are. Pizzas, hot dogs. No, I'm just playing. All right. So Costco is doing its thing, right? CEO Roland. Yeah, that's anybody's guess. Look at all the number of employees they have. They're from Washington State, and they were founded in 1983. Costco is cooking. Costco pays a small dividend, 0.46% of that $1,000, right? So you can do the math on that. I'm not going to get into it, but it does pay a dividend. Now, 52-week highs, 1,078, which means this is not a good price to buy in at because it's almost near its 52-week high. Its 52-week low is 788. The closer it gets to that 788, the better of a buy it is. But since it's above $1,000, look for news on probably a 10-to-1 stock split. I wouldn't look any less. I don't think they do a 2-for-1. Because the reason you want to do a stock split is because you want to have more shares out there for your investors to buy. And if they split it 2-to-1, $500 is still going to be too expensive for most new investors to get into. So at $1,000, most companies are going to do a 10-to-1 stock split. So they'll be $100. Now, why is this a solid company? Well, it's a solid company because it's in retail, right? And we know the retail giant is actually the Walton family and Walmart. But Costco proved that it was COVID proof, right? It soared throughout COVID. It did its thing. Costco is held up by the many things it's getting into. So Costco sells gold, silver. It also sells products at wholesale, right? Costs like Walmart, right? They have cleaner stores, better grade of employee. They sell everything. They sell clothes. They sell meat, fruit. It's a department store of sorts, right? So, but they also have glasses. They also have a pharmacist. They do a lot of stuff. And then I showed y'all that in LA, they're also moving towards, now that COVID proof was a big one, right? Because a lot of companies went over. But let's see, Costco LA apartments. I also showed y'all this. Costco's moving towards real estate, right? And I'm trying to find an article that is recent. I'm going to see if I can find a recent article because this one's from September of last year. Let me see. Yes. Gold stars. All right. Let me see if I can find an article that's recent. No. Okay, but whatever. Costco's moving towards real estate, right? And they're trying it out in LA. What a place to try it out, right? They're from Washington State and they're going to try it in LA. Now, you have to think, why the heck would Costco be getting into real estate? The average millionaire has 7 different streams of income. And one of them, 9 times out of 10, is going to be real estate. Costco they're a distributor, or what am I trying to say? A merchant, department store, if you will. And I just told you, they sell gold, they sell jewelry, silver. You can buy gold bars, silver bars, things of that nature. I told you some of the stuff that they sell. But again, if COVID showed you anything as a company, it showed you that you can't be single faceted and still make it, right? Costco also has a card. So they also have become like a lender of sorts. They work with a lender to bring you credit. I think it's, is it Citibank? It's not Capital One. I can't remember. But they supply a lot of stuff. I'm mixing my thoughts up here because I'm trying to get to something. Why would they be going into real estate? COVID showed us that if you're single faceted, you can plummet just like a single stock, right? Which is why ETFs, electronic transfer funds, are a really good idea, right? And what is an ETF? Let me see. This is one that Invesco QQQ. This is one that I have owned in the past. I made some money off of it and I sold. Why is an ETF a good idea? Well, it's not a single stock. It is a single stock, but you buy a single share, but it's made up of probably over 100 different companies. Where is it? Oh, right here. 102 different companies, right? So if one of them's not doing so hot, Tesla's tanking, well, there's other 101 companies to hold this up if they're doing great. The top 10 companies in this is Microsoft, NVIDIA, Apple, Amazon, Broadcom, Meta, Netflix, Tesla, Costco, bam. So 8 out of 9 of the top stocks, well, let's do 9 out of 10, are all tech. And look, you've got one retailer in here and it ain't Walmart. You see that? That's why I'm saying Costco is a solid company, right? They're more than solid. If I had a retailer that I was going to invest in, it wouldn't be Walmart, it'd be Costco. Now, why are they trying to get into real estate? Because do I need to show the roots example? Where was that roots? The roots thing I did the other week where I drew the tree with the many roots going down into the ground. Somebody done used my notebook for something that it was on a note card, wasn't it? I'm gonna find it. Okay, so Costco has their roots down, and let's say they invest in the clothes. That's one root. Now they have meat. That's another. Now they have produce. That's another. Y'all get what I'm saying? They're moving into different sectors. Here it is. So I need to do this better. So the squiggly line going horizontal is the ground, right? And then the two that you see above the ground is the trunk of the tree, right? So the trunk of the tree is right here. This is the ground, and here's the many different roots, right? This is all the things that Costco's investing in, right? And so this is what's going to hold Costco up. If one of these roots dies, this tree will still be a very healthy tree because Costco's getting into a lot of stuff. Now, real estate. Why are they getting into real estate? Because real estate is one of the best cash investments you can make. And also, you can do a lot with tax write-offs when it comes to real estate if you are a business. And so it also can produce a lot of cash for you in tax write-offs. Let's just go with that, right? Now, they are building apartments on top of this Costco. This is what it's going to look like in LA. I don't know if it's finished, but I think this is either what it looks like. Is this what it looks like already? Is it already built? It was approved in 2022, so it might actually look like this. I'm going to try and find a recent picture for y'all, but this is what it's going to look like if it doesn't already look like this. Now, why is this big news? Because one of the biggest things plaguing America, especially in a place like LA, is affordable housing. There's a homeless crisis like you wouldn't believe. Skid Row is a real thing, and it is just streets or a street with just homeless people left and right and left. And so there's an affordable housing crisis, and there are people that are earning 50 grand a year that's living out of their cars and on the streets because they can't find apartments and rent cheap enough. So they're going to get a huge tax break by a certain percentage of this housing being affordable housing. Let me try and find it. So they're even going to have, look, they're going to have a parking lot for the housing, not just for the Costco, right? So I'm sure it's going to be divided. A gym, community gardens, rooftop pool, full basketball courts. Let me see. I think I went too far. Hold on. They're going to bring 400 more new jobs. I don't know if this is a new Costco they're going to build or if the Costco's here and they're going to put the apartments on top. I think it's going to be, okay, here we go. Of the 800 rental apartments, 184 of them, or 23%, is going to be dedicated to low income housing. So guess what? They're going to get a huge tax break from the city for that alone. So there's a housing crisis, and that'll bring me, we're going to skip Costco solid. We'll talk about them next. Let me talk about one last thing, and I'm going to get off of here because my mom is leaving town today, and I got to go say goodbye. So here's going to be one of the blacksmith's next investments. So Boxable. Boxable is I guess you could say a futuristic manufacturer of homes. They make tiny homes, and I forgot what I was going to say. Man, I'm getting old. Let me tell y'all bear with me. I got gray hairs in the beard. You know what I'm saying? All right. So it's kind of futuristic, but they're building them now. They're tiny homes, and you've been looking at them. That's what I'm talking about. Yeah, me too. So you can they're actually a private company right now, right? And if you were on my last live or two ago, I was talking about, actually, it's the one I did the Robinhood earnings call. Robinhood is trying to deal with the SEC, and they're trying to take on Congress to allow their shareholders, their investors that use their platform to do something that's never really been done in the history of America, and that is invest into private companies. Prior to it going public, they are private. So investing in private companies. And why does that matter? Because right now, if you wanted to invest in the Boxable, the least amount of money, the minimum investment is $1,000. Let me see if they have the tier. There it is. So investment level, the minimum is $1,000, right? But the share price is only 80 cents. Let me get close to the mic so you can hear what I'm saying. 80 cents, less than $1. Do you hear me? If you're going to Five Guys, you are guaranteed to spend a dub. This is 80 cents, right? And it just makes sense to do because, let's see, let's do the math, shall we? That's 1,250 shares. Now, let's say this company gets a $20 or $30 million evaluation or whatever. It goes public, and these shares shoot up to, let's say it goes public and the shares are $22 a share. So that's $1,250. So they're $22. So minus not 0.08, 0.8. So 21.20, right? And you invest in 1,000 shares at 80 cents. So now, there you go. No. I did it wrong. What did I say? 21.20 times 1,250 shares. Okay, so there you go. That's what you would have, right? And that's all equity that you would have earned. And this is exactly what Yeah, exactly. This is exactly what the big corporations and people of a certain wealth class, the rich, have been able to do for eons. So when people say the rich get richer, this is one of the main reasons why. So you had to have a certain net worth in order to invest in private companies or be earning about $200,000 a year if you were single. Let's see. Requirements. I've looked this up before. I don't know why it didn't come up again, but all right. So look, you had to been earning if you're single $200,000 a year by yourself, or if you're married $300,000. You had to have a certain net worth. I think it's like, oh look right here, at least $5 million in assets, and it's not including your house. Actually, you can't use your house because some people could get in that way, and there was something else I think. But whatever. So right there, you are X-naying 95% of people who ever lived, right? So if Boxable is letting you invest in them as a private company, huge. Robinhood moving to allow you to invest in private companies, huge. And Congress has a real they're a real wall standing in the way. They have a real reason to not do it because then you're going to allow the average Joe to start investing like we're investing, which takes away from our profits and our money. And then that's going to allow them to creep up into our asset class. We don't want the riffraff. That's how some of them think, right? But you have an opportunity here to do it. So I've already signed up to invest in it. Now, what do? Well, they make affordable homes that you can actually buy and own. So let's look at the Casita, right? The Casita is their premier home. It is a 361 square foot home. It's got 8 foot tall. Well, the ceiling is almost 10 feet tall, 9.5 feet. It's like let me see. Do they have they have images right here. It's quick scrolling. So here's like a bedroom. Here's the kitchen, right, with a countertop. Look, you get a full size fridge. Now, these appliances come with it, right? So I just showed you, first of all, no, let me not get ahead of myself. So you get a fridge, stove, and it's a full size bed, but it's in a couch. So it's a pull out bed. But the bed, there was like a guy who was like 6'1". He stretched all the way out in the bed and he still had like room left, right? So a tall person can buy this and still have a good amount of room to move. Now, most people will sniff at this, laugh at this, be like, look, they put a bed in this one, but I know I saw the Casita. You get a washer and dryer as well. Full size washer and dryer. It's not one of those little Timo things. It's actually a livable space, right? It's a studio, right? Now the Casita costs $60,000, but you can buy this. It does not need a concrete. It tells you the whole history behind it too. It does not need a concrete foundation. You can put it on grass. It has wheels so you can pack it up and move it. And also, what's another good thing? Oh, remember, you're owning this. You're not renting this. So let's do some easy math, right? Now, I doubt they'll give you a loan for 30 years on this. But I just showed you the average house was $415,000 at the low end, right? Most people can't afford that. Let's just be real. And interest rates are like 5% right now. I don't even know if this is the proper way to do this, but that's 20G. Nah, this ain't the proper way to do this. But you get what I'm saying. Most people can't afford a mortgage with $415,000, right? But they can afford a $60,000 mortgage, right? Now, if they gave you the loan for 5 years, right? You'd be paying, I did that wrong. You'd be paying $12,000 a year, but hold on. I can do math. I said 5 years, so not 72, it'd be 60 months. So it'd be $1,000 a month with no interest. Now it's going to have interest. Let's say it takes you up to $1,200 a month for 300 square feet. Okay. If you pay that in San Diego, do you know what the average rent is here in San Diego, in Southern California, period? So this would be a dream, right? And let's say you could make this. I don't know what kind of loans they're giving, but let's say you could stretch this out to 72 months. It's even lower, right? What'd you say? Cost to get the land ready to water, sewage, etc. Yeah, that's true. That is also true, to buy land and development and stuff like that. But this is another reason why, I'm in Riverside County, just north of San Diego. I'm interested in looking at land and stuff, because here's what I think is going to happen. MG the mortgage guy, you can look him up. I'll put that in chat. MG the mortgage guy. He wrote a book called House Hackonomics. Yes, House Hackonomics. Right? Look that up. House hacking is going to be a thing in the future. I'm going to tell you right now, people are already doing it. So when I was looking for a home, I'm going to wrap this up real quick. When I was looking for a home 3 years ago, I almost bought a home that was it was 4-bedroom, 2.5 bath with a 2 or 3 car garage. And it actually had an ADU. So technically it was 5 bedrooms, but one of the bedrooms was an additional dwelling unit that was actually being rented out. It had a renter in it, and it was producing like $1,500 a month from the renter. The renter knew the house was for sale. And so when they went to show the house, the renter, they were there and they would step out or move away or whatever, or stay out for showings of the home. They worked with the seller. And so I almost got that house because I thought about it. Well, it's already house hacked. That's one way that you can own a home and reduce your mortgage, really, because you're paying, let's say you pay $4,000, but you're recouping $1,500 of that. That's a good kickback right there. So what I'm thinking, people are going to take their backyards, and they're going to, if the zoning laws allow it and all that kind of stuff, and they can hook up pipes and sewage or whatever you need for these things, they're going to house hack their own house and put 2 or 3 of these in their backyard and bring renters in, right? Think about it. We have a housing crisis in America. Most people can't afford a single family home, a standalone home. So people are looking at duplexes, triplexes, quadplexes. They're looking at condos. Tiny homes is going to be the next move. You heard it here first. If you haven't heard it yet, if you didn't hear it first, put me in whatever number you heard it, but I'm not kidding. Tiny homes is going to be the next move. If you can invest into something like Boxable, if I were you, I would start looking into it seriously before the opportunity cuts off, before they get enough investors, before they say, okay, we're going to get our valuation and go public, because then the shares might move up to like $25 a share, and you might have missed a great investment at 80 cents. All right. That's all I got for y'all this week. Thank you for joining me. Listen, I'm going to try not to start late again because I got phone calls and requests. And am I okay? Yeah, I'm okay. There's stuff going on because I'm usually very punctual. I get it. But I'm glad y'all appreciate the content. But I will see y'all next week. The Forge is going cold. The Blacksmith Podcast is out. Thank you, folks. Have a great week.